Hi, everybody, and happy Valentine's Day. Thank you for joining us on February 14th for our special Valentine's show. None of us are wearing any hearts or anything like that, but we should still have a good time. We have a little bit of a different cast for you today. We are missing my co-host, Lauren Johnson, and we are missing our training person that always does training with Rick Tankersley, but we've got a good show for you. We've got some special guests that are going to give us a lot of good info and be able to help us with realtors. So without any further ado, we're going to go ahead and get started. I'm going to handle the Jet Closing introduction real quick. My name is Steve Harris, and I'm with Jet Closing here in Nevada. And one of the things that I always like to talk about is that while we are not a discount title company, we do actually save your clients fees on both sides of the transaction. So if you're looking at my screen, you can see that we have a flat fee per side of $500. For our escrow fee does not increase with the price of the property. So it's always going to be a flat $500 fee on each side. And you can see some of the benefits as far as what's going on, as far as what we can offer. No junk fees, wire fraud protection, and free mobile notaries anywhere in the U.S. At Jet Closing here in Nevada and Arizona, we always want to take care of you and deliver 5-star service. So we look forward to working with you soon. Ryan, take it away. It's on you.
All right. So credit repair tip of the week. This one's going to focus on the amount owed section. The chart that you see in front of you, it's a representation of what makes up a FICO score, and 30% of that, a very, very big portion, is the amounts owed. So what is that? 30% of the amounts owed is equivalent to 165 points. 165 points could take you, as far as a mortgage is concerned, from qualifying with the 700 score all the way down to the low 500s where you don't qualify. So some tips for how to actually get that down is your credit card utilization. That amount's owed, it's most heavily weighted to the credit card utilization, and that's anything that has a revolving balance, like your Visa, your American Express, anything else like the gas card, department store card, where you pay the balance down and you have a credit limit. The other parts that make up that score but aren't as heavily weighted are other loans, like your car loans, things with a balance, but that's not the biggest focus of it. It can get penalized, though, if you owe more on a loan than the original amount. So if you had like a $15,000 car loan and you now owe $20,000 because of interest, then you'll have the penalty in there. The best thing that I can suggest, though, for the credit card balances, it's a method called all zero except one. And what that is just basically paying your credit card balances down. If you have multiple credit cards, zero all of them out except for one. And then the one that you keep a balance on, that should be somewhere in the 5 to 9% range of the limit. So if you have one credit card that has a $1,000 limit, keeping no more than about $50 to $75 when your balance posts, you'll get the most points added to your FICO score. If you go over 10%, you'll have a little bit of a penalty. And then if you go over 30%, you'll have the harshest penalty. That works by card and then for your overall utilization. So if you add up the aggregate of all of your credit cards, if it's over 10%, you'll get penalized. If it's over 30%, then you'll have the most harsh penalty. And then that also applies again to each individual card. That's something that credit repair cannot fix, is an open account that you have a balance on, but that's something that's very easy to self-manage and give yourself an advantage when you're applying for any type of loan, be it a mortgage, a card, just keeping that utilization under control and under 10% of the limit. And then for the most points, that all zero except one method of having everything paid off to zero except for one card, and then just keep a very small balance on there. And then the one caveat to that is that you actually will get penalized on your FICO score if you have zero balance overall on your utilization. So if you pay off all your credit cards, you'll actually lose points. That's why it's important to keep a small balance on at least one of them. That is what I've got for this week.
Perfect. That was very, very interesting. So just to kind of go over, to the credit card, would you suggest with somebody that's got multiple credit cards, get one paid all the way down and then move on to the next one as far as a strategy?
Yeah, I tend to tell my clients to pay off the smallest balances first. So if they have multiple cards with balances, just tackle the small one and then move up the chain. And then the other way that could be a way to prioritize it is if you have one that carries a much heavier interest rate than the others. If you have one, like a balance on two cards, one has a 15% interest rate and the other one has a 25% interest rate, then it might be more advantageous financially to pay off the higher interest rate. So you end up paying less to the banks.
Perfect. Well, we appreciate your time, Ryan, and thank you for the credit card tip of the week, or credit
Thank you.
card repair trip of the week. Probably should say it better. And appreciate you coming with us. Vince, we're going to
Thank you.
move on to you.
Okay, hello everybody. Vince Mazzacco, independent mortgage broker, rates and fees the lowest for the consumers, servicing Arizona and California. Okay, so this week here, we're just checking in what's happening in the market to keep you guys abreast of what's going on as far as interest rates are concerned. I'm going to show this chart on a regular basis. This is mortgage bond prices. As prices of bonds fall, interest rates go up. And you can see over the past couple of days here, we've had some pretty rough going here over the past couple of days. Some tensions over in Russia and Ukraine had the market a little skittish on Friday. Then those tensions eased and things kind of bounced back. A green day, by the way, a red day, we opened at the top of the box and we closed at the bottom of the box. So red day means the price of bonds were down, which means interest rates jumped. So this would be Thursday. Friday, we started off way down, but we actually gained a little bit of ground late in the afternoon. So, as the Fed, this week is going to be an important week. We've got some important economic data coming out. We've got the Fed minutes coming out later on this week. This is from their January meeting. And the bond market, generally speaking, does not react well to what the Fed comes out and says. It doesn't really matter what they say. The bond market seems to not like what they have to say. So we could probably anticipate a little bit of a pullback in price on bonds, which means we could creep up a little bit. And then additionally, we have NAHB coming out later this week, the National Builder Confidence, what their confidence is and what else coming out. PPI, I think, is coming out, Producer Price Index a little bit later on this week. And there was another big one. What was the next one? Won't pop in the top of my head. So, but, as we go into into the summer and the Fed talking about raising the overnight lending rate. James Bullard came out this morning, and he said, he would like to see a 1-point hike in the overnight lending rate by the time July comes around. And there's only 3 meetings between now and July, which means in one of those situations they have to hike rates a 0.5 point. So, and counterintuitively, when the Fed raises the overnight lending rate, that's raising rates on your car loans, your credit cards, and those types of things. But it may actually have a reverse effect as far as long-term bonds go, because the Fed's fighting inflation when they're raising the overnight lending rate. So if they're fighting inflation, the long-term bond market, which is what mortgages are, right? 30-year fixed rates, 15-year fixed rates, they may actually like that they're fighting off inflation, and rates could actually improve because we've lost a ton of ground. We've gone from late December here in the low 3s to now into the low 4s. That's how much we've lost, how much ground we've lost in just 30 days. Now, I don't remember if I pointed this out last week or not, but if we look at the Treasury yield spread, this is the difference between the 2-year Treasury note and the 10-year Treasury note. So it's the 10-year, which is always a higher interest rate, right, because it's a longer term, and the 2-year Treasury yield, which is always that's a short-term rate, so that's going to be a lower rate. So, every time we bump into a recession, the 10-year minus the 2-year goes negative, and these gray areas are recessions, right? So we bumped into a recession. Every time we've gone negative, we bump into a recession. And that's happened every time over the last 40 years, going back to 1980. So now look what's happened here, interestingly, since April of last year. There was a almost 150, 1.5% interest rate difference between the two. And now we're already down to what, 0.62? And if the Fed starts to raise the overnight lending rate, that affects the short end of the curve, which is the 2-year, which means the spread is going to get closer, which means a recession could be looming, right? Well, this is going to unplay over time. So while rates are getting higher right now, when we generally bump into a recession, rates have a tendency to improve. So so that's kind of the weekly cap there as far as interest rates are concerned. And that's pretty much it.
Thank you, Vince. I think that was extremely informative as far as what's going on and what you're seeing from a market and mortgage market standpoint.
Yep. And actually, let me chime in there. So I didn't mean to cut you off, Steve, but let me kind of throw in the 10-year Treasury note here.
Okay.
Let's look at the 10-year Treasury note. So it's been up, it was up quite a bit today, and it keeps coming up. It came up to a ceiling here. Okay, so we came up to the ceiling at 2.05. That's the interest rate on the 10-year Treasury. So we came up to it on Thursday. We come up to it on Friday, right up and touched that ceiling, and then we pulled back. So now we're trading in a wide range, right, between 205 over there in the black on the right and our floor of 189. So we're trading in a wide range. So we have a tendency to get whipsawed, when we're in this big wide range. So, hopefully we can see a little improvement on the 10-year Treasury. Interest rate comes down, and that would give the mortgage bond interest rates a little bit of a boost, so rates could improve should we move to the downside.
Gotcha.
But that'll be dependent on what comes out later on this week as far as inflationary pressures go.
Well, I'm sure you'll have much more good information for us next Monday too to tell us what happened.
Yep, we'll keep you posted.
Appreciate it, Vince. All right, that was great info. We're going to move on to Jeremy. Jeremy with Fairway Mortgage, please take it away.
Hey guys, how you doing? Fairway, Jeremy Crudup from Fairway Independent Mortgage. We're a nationwide strength with hometown service. So I'm servicing Nevada. So anything I can do to help you guys in Nevada, let me know. The rising cost of college in the United States. Now, how this is going to play into effect is really with student loan debt. In May, the forgiveness for student loan debt is going to go away, and it's been paused for the past 2 years. So Americans are going to have to start repaying a lot of this money, and along with what Vince was saying about inflation and rising rates, there's kind of this bubble that we kind of see coming up. How this is going to affect borrowers is, as they start to have to repay this is going to be added to their debt to income ratio. It affects them negatively, which can hurt their purchasing power. Right now the average cost of college is $38,000 a year, and it's not going down. As you can see in this graph, it's continued to go up year after year. And as these students get out of college, they move into the apartment life, and a lot of what we're seeing right now is a lot of these borrowers or a lot of these workers are now wanting to buy a home. They're moving from apartments over to trying to purchase a house. And I'm just running into personally a lot of these people who have debt to income ratios that are affecting them negatively. Just so that some of the realtors on this call that are watching the show are aware, as loan officers, we have to attribute 0.5% to 1% of any student loan debt to their debt to income ratio. So if you owe $50,000 in student loan debt, that's going to be a $500 a month payment on a conventional loan, or a $250 a month additional payment on an FHA loan. So the real story here is, as realtors need to kind of attack this as another Q&A for when they're talking to borrowers, because this will come into play. I typically run into this after we've obviously run people's credit, and at that stage they're kind of stuck. I have to give them the bad news that they're not going to be approved due to their lack of debt to income. So it's an unfortunate situation, and I just see it playing out in the next couple of months, along with what Vince said with the rising rates. Could kind of turn into a little perfect storm for some trouble for people and their purchasing power. Vince, do you have anything that you're running into with student loan debt in some of your applications?
I haven't had anything impact their qualifying ability. So yeah, I see them, but I haven't bumped anything where it's actually impacted them.
Okay.
Now, do you guys have the ability to do Freddie as well?
Yes.
Because you can do, because I know you set a point for conventional 1%, but with Freddie you can actually do 0.5% as well.
Correct.
Yeah.
Yeah,
So,
we do Freddie also.
okay, got it. Yep. So, but yeah, there's definitely some of those I've seen with those big loans. People have $100,000 hanging out there. That's a big hit.
Yeah. How about you on the credit side?
Not as of yet, just because of the fact that everything's in forbearance. So I'm not seeing the negative marks adding up. Most of the people that I have in credit repair are going to have late payments, and those haven't been accruing since the forbearance and deferment started.
Yeah, I agree.
But the other part from credit repair too is that I can't affect that because of the CAVERS database. If they're going to apply for an FHA loan or even sometimes conventional loans, that's going to come up on the mortgage side, on the underwriting side, because even if I get that off of a credit report, it's still going to end up being there until it's out of default.
So yeah, that's my little 2 cents on student loan debt, and another thing we're seeing in the market right now with loans. Thank you for the opportunity to chat with everyone. Happy Valentine's Day as well.
Thank you so much for that information, Jeremy. And Ryan and Vince all answering their questions. All right, so for our next segment, we have a very special guest. It's his first time on the show, so I want everybody to be semi-nice to him. Not totally nice, but semi-nice to him. Our guest on the show, his name is Andrew Bang. He's actually opening up an office in Las Vegas that we are very, very excited about. Andrew specializes in hard money lending. This is a very big passion of mine because I've done real estate investments and I couldn't do it without hard money. So I'm going to let Andrew take it away and also explain what hard money is.
Great. Thanks, Steve. Yeah, so I'm located in Arizona. Boomerang Capital is the company that I work for. We are a privately held, non-traded REIT. It's basically a big fund of investor money, and we lend out of that fund. And we do hard money or private money loans. And they are specifically used for fix and flips or fix and holds. So they're short-term, high-interest rate loans that have very little, if no underwriting for the borrower. We look at the property. It is an asset-based loan. And they are the equivalent or as close to a cash offer as you can get and still have a loan. And they're like that because I've never pulled credit on anybody, and I never will. I don't even know how to pull credit. I've never asked to see someone's tax returns. Never verified employment. None of that matters with a hard money loan. It's all about the property. Are you buying it at a price where there's a margin in it to fix it up and sell it, or fix it up, keep it as a rental and refinance it? So I'm that bridge loan right at the beginning. And so I'm not sure, flipping is becoming more and more popular. There's more and more people getting involved. Over 10% of the market on the MLS is flip properties. And so if you are a realtor and you have someone that comes to you and say, oh, I'd like to flip a property, I'd like to get involved with this side of it, they don't need to have the full amount of flips. Few investors do. And the ones that do, they don't use all their money on 1 or 2 homes. They leverage that money. So as a private money lender, I can lend up to 90% of your deal. So you just have a 10% down payment. So you could flip a $400,000 or $500,000 property with only $40,000 or $50,000 because you just need that 10%. And then I provide the rest of the purchase, and I provide all of the rehab as well. So I set funds aside that you draw upon to complete the rehab, and then you flip that house in 4 or 5 months, and you move on to the next one. But there's few realtors that I've found that are really involved in this side of it. I'll go to these real estate conventions and events, and I'm surprised at how many realtors are there compared to investors and wholesalers. And it's this whole off-market property, wholesale properties. It's really those type of properties that I deal with the most. There's not too many homes on the MLS that make good flips right now because of the lack of inventory. But there's plenty of off-market properties. And people are flipping more homes now than they ever have before. And it keeps me busy. But for a realtor, you go out and you look for all these clients, and you find a client, and you might get to sell their house and help them find a house to buy. and you get 2 commissions. For a fix and flip investor, they're flipping 3 or 4 homes a month if they're doing it full time. So you're doing, a commission on the front end and a commission on the back end on 3 or 4 homes every month for the same investor. And for those realtors that really get involved in this market, their commissions go way up. They don't have to do as much marketing because they just find a handful of good investors and they're just listing and selling their properties.
So if you have a realtor, Andrew, that is trying to get into the investment space, what would you say is a good, because there's got to be like investment 101 or something. Do they reach out to you? How do they find out more info to make this work?
Yeah, absolutely. I'm available. I consider myself a relationship lender. I go out there. I don't really advertise online. I'm all face-to-face, one-on-one. Let's sit down. Let's have lunch. If you're a realtor just getting involved, I'd say education is the best way. Start learning about wholesale properties. In Phoenix, there's probably 100 wholesalers. In Vegas, there's probably 50 wholesalers that are putting out off-market properties every day. You need to get on all their lists. You need to start getting those properties so you can set yourself up as an investor-friendly realtor, someone that's going to help an investor find the deals. And those deals are off-market. They're not going to be on market.
No, by the time they hit the market, they're overpriced.
Yeah, absolutely. But there's Facebook groups are great to join. Vegas has a couple good ones. And then there's RIAs, Real Estate Investment Associations. And in Vegas, unfortunately, I think they only have one right now that I know of that meets monthly. Their bigger one, which is the Las Vegas RIA, they're online right now. I think they have some subgroups that meet for lunches, but you need to get involved with those companies and those groups.
Gotcha. Okay. Well, thank you for your time, Andrew. Really appreciate you coming on the show today and kind of getting us a little bit more knowledgeable at hard money. I think the biggest thing when you're looking at hard money and investors, if you're trying to dip your toe in the water, is just the fear of the unknown. And because, let's be realistic, an investment property and a hard money loan, it's not that it's complicated, it's just something different. And you hear all of the horror stories and all those kinds of things out there. And we've seen them entitled too. We had a property that came in that was a flip that had 0 permits pulled. And all that kind of fun stuff. So that may be something that's holding people back too.
Yeah. You hear about these hard money lenders that are national guys and they don't know your market. And a lot of them are considered sharks. They're doing hard money loans at a high interest rate and they don't mind if they take the property back.
Right.
So you want someone that knows the market. We are going to be opening an office in Vegas. I started doing loans there last month. It's my goal to know every single neighborhood in Vegas. I want to be putting loan quotes together in 10 minutes or less. I want to be familiar with all these areas and be able to provide a value to investors, to realtors. And because we want to send our money out and we want it to come back with friends. We never want any properties. And that's my background is not banking. It's flipping homes. I've been flipping homes for 14 years now. 4 years ago is when I started concentrating full time on the money side. I will do everything I can to help you make money on that flip, because once you make money on one flip, you're going to want to do it again and again and again.
Yep. Once you catch that bug, you're bit. Well, once again, thank you, Andrew. We really appreciated you coming on board. We're always going to ask the same question. What can we do, or what types of challenges do we see realtors seeing today, right? We talked a little bit about on the mortgage side, we're seeing rates that are increasing, which means apps are dropping and things like that. People may be having trouble qualifying. Andrew, you're seeing the same thing a little bit with everything on the MLS is overpriced from an investment standpoint. If you're an investor, you have to go with these off-market deals, which has a little bit of issues there too. But so I'm going to start the question with, what are realtors telling you from a feedback standpoint? What challenges are they seeing, even from conversations last week? Does that make sense? And the first person I'm going to go to is Jeremy. What is your conversation with realtors been like, and what challenges are you seeing?
Honestly, inventory is a big one. Still tons of lack of inventory. A lot of competition bids, still a lot of cash bids. People are losing the cash a bit here and there. It's just kind of savage out there, to be honest. A lot of people are, 3, 4, 5 bids on different homes, and I had some clients that had buyer fatigue. They were just over it. They're like, we're just going to rent another 6 months. We'll call you in a couple months. It just, people are they're just having a hard time. It's getting more and more expensive, and the inventory's low, and there's not a lot of new homes being built. So, it's tough.
Vince, what are you hearing?
You know what? I just gotta, Jeremy's in the mortgage business just like I am. It's the exact same repeat. Just lack of inventory, buyer burnout, and that's probably the biggest two things that are, the hurdles. Rates generally speaking don't stop people from purchasing. So even though rates creep up, as long as they qualify, it usually doesn't stop them. Like right now, the industry just did the FHFA instituted an LLPA, loan level price adjuster, and it's for second homes. And second homes I do a ton of second homes here in Phoenix. In fact, it's probably 30, 40, maybe even 50% of my business. And I bet, Jeremy, you probably have a decent of second homes too. And those loan level price adjusters, they're trying to, the interpretation from the FHFA is it's a riskier loan. We need to offset the risk. Seriously, second homeowners are not risky. They're the ones that are making 500,000. They have multiple properties. They have $1 million in the bank, or 2 or 3. It was try to stop in my interpretation. It was try to, hey, let's make it more expensive for second homeowners so they don't buy. So that leaves more properties for primary homeowners. But I reached out to all my second home buyers, and that loan level price adjuster, even as abrasive as it was, didn't slow anybody down. They were like, oh, well, that sucks. Excuse the French. But they're continuing on. So, but those are the things that are challenging us right now. And with the Valley here, and I think Vegas is the same way, we've got 5,000 or 6,000 people a month moving to Arizona, into Maricopa County. And we don't have enough houses, right? So that ain't stopping anytime soon. You can't ramp up that fast to catch up to the housing demand. So unfortunately, that's just going to keep upward pressure on pricing.
Well, and I think that it's not only that you're seeing, low inventory and everything else, but when you look at supply chain issues from a home builder standpoint, that's not helping either. And I think that needs to be said too, that, for the new home builders, when you're looking at your Lennars, your Richmond Americans, your Pulte's and everything else, they're still having trouble getting electrical boxes in. They're still having lumber issues. They're having, and not only are they having material issues, they're having labor issues. So I think all of those are factors that can hurt, the market and the inventory situation too. So I think it's almost like that George Clooney movie, right? The Perfect Storm, where they got the, wave coming and everything else. I think we're almost there, but I also think that there's a lot of good indicators that we're coming out of it. So I'm going to open it up to you, Andrew. What are you hearing from your realtor partners from last week?
Yeah, so realtors, there's a lot of realtors that are frustrated right now. And I see it in the older realtors that have had success in the past, but their traditional marketing is not working like it used to. Farming neighborhoods, it's not bringing in the results and the leads like it used to. And it's time to get creative. Realtors, you gotta learn how to use iBuyers to your advantage. I teach a whole class on how can realtors compete with iBuyers? And it's really understanding this whole other side of the market. It's really understanding the real estate market as a whole, not just the properties that are on MLS. And that's the other part. We always talk about inventory. Oh, there's a lack of inventory. Well, you talk to title companies, and Steve, you know this best. Title companies are closing on just as many, if not more, houses than they ever have before. So it doesn't make sense. There's a lack of inventory, and buyers can't get a house, but yet title companies are still closing homes. So I would suggest there's not a lack of inventory. There's a lack of inventory on the MLS. There are still buyers finding homes, sellers, of course, super easy to sell homes, but I hate to say it, they're not using realtors as much as they used to. So many people are selling their homes and so many buyers are finding homes through ways without realtors. And title companies are still closing just the same amount of loans of closings or more. And I'll give you an example. So I keep my real estate license because I want access to the MLS. And I had a friend the other month that has a rental here in Phoenix. And he goes, "Oh, Andrew, can you list my home?" I said, "Sure, I'll throw it up there." And I priced it at a price where it was just above the comps at just a crazy high. It was $400,000 in Levine, small 3-bedroom, 2-bathroom house. And I get multiple offers above asking, cash offers. And some of these big funds come in and I got a cash offer for 430 for a property that I didn't see a comp above 380. So we accepted the offer. And then I'm talking to this realtor and she's like, "Yeah, we're buying 100 homes a month. This fund's buying 100 homes a month." And so what do? Well, I've got other friends that have rentals all over the valley. I call them up and say, "Hey, send me your address. Do you want a cash offer that's going to be above any comp right now in your neighborhood?" So I sold 3 of their homes to this same fund. You know, there's realtors involved, but these homes never made it to the MLS. These are great homes that never saw it, but they still got sold.
And I think there's 2 things I think that you touched on. First thing is if you'll put your class in for the realtors for the investment side in the group, Andrew, and we can probably try to get some people attending from Arizona and Nevada that you may not have gotten aware. And then the second thing is as far as, and this is one of my soapboxes because I've got a 20-year background in marketing. Traditional marketing methods aren't working. You know, when you look at the old traditional farming methods with the postcards, going knocking on doors, you know, open houses and everything else, these are all of the realtor bread and butter traditional marketing, right? And we offer postcard marketing programs here too. But I think one of the things that have really not helped traditional marketing is kind of the blowback with the privacy where we can't really know who we're targeting, right? We used to be able to filter by income, filter by credit score, filter by, you know, all these different things that have been taken away from us. And it's actually made marketing more messy.
Absolutely. Yeah. I mean, and then you have the other part of that is you have all these investors out there who aren't licensed realtors, and they are doing very similar marketing, except they're not saying, "I'll list your home." They're saying, "I'll buy your home for cash."
Yeah.
And so people are getting the same mailers in the mailbox, and they're like, "Well, I could list my home, have to pay the realtors, 5-6%. There's no guarantee of when it will sell or for what price. Or I could go with one of the iBuyers, or I could go with, one of these brokerages that buys your home, or I could go with any of these other, smaller investors, and they'll give me a cash offer and they'll let me stay in my house for 60 days rent free as I look for my other home while the money sits in my bank account. And I'm able to make a cash offer on another home. There's, and realtors, there, a lot of times if realtors don't think if a buyer goes to like a iBuyer or these investors and it doesn't fit in the realtor box, they're like, "Oh, well, you're not going to get as much money. It's going to be a messy process. You're dealing with someone that's not licensed." And more, this is not the case where people are getting full price cash offers from people that don't have anything to do with being a realtor.
Is that sustainable though? I mean, because when you're looking at these real estate investment firms and they're paying so much over the list price, and we all know what they're doing, right? They're doing buy and hold. They're sniffing for equity and they're sniffing for yield because the stock market and all the bonds and everything else, as Vince just showed us, isn't giving them that yield. We know real estate can give them that yield, but is it paying off or is it going to remain to be seen what's going to happen here?
No, it's not sustainable, especially at the prices now. I mean, that Levine house that they're buying for $430,000, it's going to rent for maybe $2,000 a month. There's no cash flow in that, or very little. Once you have all the maintenance and cost. But they like Phoenix has had 20% appreciation the last 3 years. Vegas is very similar, and so they like very little cash flow, but great appreciation. And if it continues, then it makes sense for them.
So they're sacrificing cash flow for the appreciation game is what they're doing then.
Yeah.
Okay. That's interesting. We'll have
Yeah.
to see if that strategy plays out.
Mhm.
So, well, I think that we have had a very, very successful third show. I want to thank everybody for participating in our Keeping It Real in Real Estate. I think that the discussion that we had as far as all of the different areas of the market and what we're seeing from challenges of realtors and everything else, the hope is that realtors will be able to watch this show and gain something that can help them, right? Gain some kind of information or anything like that, so that we can help them, do better business, because that's what we're looking to do, and that's the whole vision of this show. So appreciate it, you guys. Thank you so much, and we'll see you guys next week. Thank you.
Okay, sounds good,
Thanks, Steve.
everybody. Have a good day.